Right now, for less than the cost of your lunch, you can own a piece of Apple, a piece of Tesla, a piece of McDonald's. Not their products, the actual companies. Not a coupon, not a loyalty card, an actual ownership stake in a business that makes billions of dollars a year. And almost nobody does it, because almost nobody actually understands what a stock is, why it exists, or how it makes you money. By the end of this video, you will, and you'll never look at the stock market the same way again. Most people treat the stock market like a casino. Red and green numbers flashing. Words like bull market and short selling getting thrown around like everyone's supposed to already know what they mean, and it all feels designed to make you feel stupid for not understanding it. So a lot of people do the safe thing instead. They keep their money sitting in a savings account earning almost nothing, while inflation quietly eats away at its value in the background year after year. Here's the uncomfortable truth about that. Keeping your money in cash isn't actually safe. It feels safe because the number in your account never goes down. But the number isn't the point. What that number can buy you is the point, and that's shrinking every single year, a little more than most people realize, until one day it's a lot. Stocks aren't a casino, and they were never supposed to be intimidating. They're ownership. And once you understand that one word, ownership, almost everything else about investing starts to click into place. Let's strip away the jargon completely with one simple example. Imagine a kid opens a lemonade stand. Business is good. People love the lemonade, but to actually grow it, she needs a bigger stand, more lemons, a proper sign. That's going to cost $1,000. The problem is, she only has $400 saved up. So she does something clever. Instead of going into debt or giving up on the upgrade, she cuts ownership of her lemonade stand into 10 equal pieces and sells 6 of those pieces to friends and neighbors for $100 each. That gets her exactly the $1,000 she needs. But here's the part that actually matters. Everyone who bought a piece now owns part of that lemonade stand. Not alone they need to be repaid, actual ownership. If the stand makes a profit, they get a slice of it. If the stand grows and becomes more valuable, say it opens a second location, their piece becomes more valuable too, automatically, just by holding on to it. That, in its simplest possible form, is exactly what a stock is. A company, instead of a lemonade stand, think Apple, Tesla, or Coca-Cola, cuts itself into millions, sometimes billions, of tiny ownership pieces called shares. When you buy one share of a company, you are not gambling on a number bouncing up and down on a screen. You are buying a real, legal sliver of ownership in a real business. Its buildings, its products, its brand, its future profits. All of it. You just own a very, very small percentage. Owning a piece of a business can put money in your pocket in exactly 2 ways, and most beginners only ever hear about one of them. The first is price appreciation. As the company grows, more customers, more revenue, more profit, more value. Your tiny slice of it becomes worth more too. Buy a share for $50. And if the company doubles in value over the next several years, your share might now be worth $100. You didn't do anything. You didn't work an extra shift. The business grew, and because you owned a piece of it, you grew right along with it. The second way is dividends. Some companies, especially large, stable, profitable ones, take a portion of their profits at the end of each quarter and pay it directly back to shareholders, in cash, just for owning the stock. It's literally the company saying, "Thank you for being an owner. Here's your cut of what we made." And here's the best part. You don't have to choose between the two. Most long-term investors get a combination of both at the same time. Their slice of ownership grows in value year after year, and it pays them small cash rewards along the way, even while they're holding on to it and doing nothing at all. Here's the part that actually builds real wealth, and it has almost nothing to do with picking the right company. It's time. If you invest $200 a month and it grows at the stock market's long-term historical average of around 10% a year, after 10 years, you'd have roughly $38,000, and you only put in $24,000 of that yourself. The rest showed up on its own. After 30 years, that exact same $200 a month turns into more than $450,000, and you only ever contributed $72,000 in total. So where does the other $380,000 come from? That's compounding. Your money earns returns, and then next year, those returns earn returns of their own, and the year after that, those new returns earn returns too. It snowballs, quietly, in the background, whether you're paying attention to it or not. This is the closest thing to a cheat code that exists in personal finance, and it rewards patience, not talent, and not luck. The earlier you start, the more time your money has to multiply on top of itself. That's exactly why the most successful long-term investors in history didn't get rich by finding the one perfect stock at the perfect moment. They got rich by staying invested, quietly, for decades, and letting time do almost all of the actual work. Now, stocks aren't magic, and they are absolutely not risk-free. Individual companies can struggle, get overtaken by competitors, or fail completely. Prices can drop 30, 40, even 50% in a single bad year, and there's no guarantee any one company bounces back. Plenty never do, no matter how big or beloved they once were. If you take all your savings and pour it into one company hoping to get rich overnight, you're not investing. You're gambling, and the odds are not actually in your favor. The smarter, more boring approach that has actually worked for decades is diversification. Spreading your money across many companies at once, often through something called an index fund, so that one bad company can't sink your entire future. We're going to break down exactly what an index fund is and how it works in the next video. But for now, just remember this one idea. The goal isn't to find the next big winner before everyone else does. The goal is to own a small piece of hundreds of solid businesses at once and let time do the heavy lifting for you. So how do you actually start? It's a lot simpler than people make it sound, and you don't need thousands of dollars to begin. Step 1. Open a brokerage account. There are dozens of free, beginner-friendly apps that take about 10 minutes to set up, right from your phone. Step 2. Decide what to actually buy. For most beginners, that's not picking individual stocks like Apple or Tesla and hoping you guessed right. It's buying a broad index fund that automatically owns hundreds of companies at once, spreading your risk for you. Step 3, and honestly the most important one, set up automatic monthly contributions, even if it's only $50, and then leave it alone. The single biggest investing mistake isn't picking the wrong stock. It's never starting at all, or panicking and pulling everything out the very first time the market dips. Owning stocks has never really been about being a Wall Street genius. It's about understanding one simple idea. You can own small pieces of real, profitable businesses and let growth and time quietly do the rest of the work for you. If this finally made stocks click for you, subscribe. Next video, we're breaking down exactly what an index fund is and why it might be the single easiest way for a complete beginner to build real, lasting wealth. See you there.